Nilesh Shah joins us now, Managing Director with Kotak AMC. Nilesh bhai, good morning. Thank you for joining us.
Very good morning.
Gold and Nifty have given similar returns. I mean, why are we doing so much of analysis every day, so much of volatility? We look at macro, we look at rupee, we look at earnings, we look at P. Life is so simple, just buy gold, forget it.
So, Nikunj bhai, we'll have to figure out when Indians decide to sell gold, who will buy. Today, gold prices are up because we are one of the largest buyer. Fortunately for India, central banks of the world have become like our housewives. They have realized that keeping money in dollar, yen, euro, renminbi securities is risky, as Russian central bankers have realized. Now they have joined the bandwagon and they are buying gold as much as Indian housewives are buying. So yes, undoubtedly gold looks on a better footing. It has delivered great return like equity, but we'll have to realize whether we'll be able to liquidate gold or not.
Okay. Now the point is, where do you go from here? I mean, we always talk about equity markets, but let's first understand where is the earnings and economy headed, and is it now time to be optimistic because the macro, the data points in terms of tax collections, oil, dollar index, the macro is getting better now.
So Nikunj, it is not about macro going down or earnings not growing. It's all about meeting expectation. At 22 times forward, earnings expectations were running in double digit. Actual earnings came at low single digit, mid single digit. In every quarter of this year, Nifty 50 earning per share is more than 250 rupees per share. Overall, we are on our way to achieve 1030 Nifty EPS. The growth is likely to be mid single digit over last year, and that was below expectation, which is why correction has set in. Now, expectations are low, and there are reasonably good chances with good monsoon and improving domestic macros. We should be able to get somewhere around 1150 EPS for Nifty 50 next year. It is the earnings growth ahead of expectation which will drive the market upwards.
So what should be our approach now? Stay with the market or sell the market on every uptick?
So Nikunj bhai, in the short term market is like voting machine. Money flow determines prices. In the long term market is like weighing machine. Fundamentals determine prices. As of today, FPIs are seller. They have been selling quite consistently, quite aggressively. Their side is well known. No one is going to give easy exit to them by taking market up. If they are selling, market will continue to fall. As their selling stops, market will bottom out. And as their buying starts, markets will start rising. Undoubtedly, over longer term, fundamentals will play. This is fair value market where large caps are below historical average. Mid and small cap are still around historical average. So you should maintain neutral weight to equity. Give preference to quality over momentum. Give preference to high floating stock market determined prices versus low floating stock kind of manipulated prices. And go for reasonable valuation over expensive valuation. Be overweight large cap as small and mid caps are still trading at premium to historical average. Most importantly, don't buy everything in correction at one go. Keep on adding on a calibrated basis as FPIs are likely to sell for the near term.
Right, so those are like very pertinent trading strategies or other investing strategies for our viewers. A very good morning to you, Mr. Shah. This is Cheryl also joining in the conversation, and you did mention the fact that you should be overweight on the large caps, stagger your buying, try not to actually venture into this mid space, at least as of now. But when you talk about large cap and when you talk about the large exposure on the markets, it has to be the banking space. So is that the space that you would advise one to look at very closely, given the fact that the valuations now are at a reasonable levels, and you've seen persistent selling in that space as well?
Undoubtedly, the FPI selling in the banking and financial services space has resulted into valuations now trading way below historical average for many of the private banks. The NPA cycle is under control. RBI is improving liquidity, which will push up deposit as well as credit growth. And bearing banks which have exposure to microfinance stroke unsecured personal lending, rest of the banking system seems to be in a better position. So undoubtedly, banking and financial services one sector where one could look to add during this correction. The second space where we are bullish is consumer discretionary space. In the budget, about 1 lakh crore tax rebate is given to taxpayers. 8th pay commission should put money in the pockets of government employees towards the beginning of next year. Both these two things will be positive for consumer discretionary. We don't expect this class to spend money on roti kapda makan, the basic necessities. We expect them to spend money on experiences like traveling, like tourism, like QSR, like education, like healthcare, like premium brands. So consumer discretionary space is something which looks interesting apart from banking and financial services.
As a house, Nilesh bhai, you've been bullish on cement. As a house, you've been bullish on IT, and consumer you already outlined. Let's stay with IT. IT stocks have corrected 15 to 20%. Some stocks are down about 30%. Why have IT stocks corrected? And after the correction, are they a buy now?
So again, in IT stocks, it's all about expectation. There was fear that US might be slowing down. The Google searches on US recession has increased. So we are probably looking at hard landing as well. That is direct impact on IT business. The second challenge is of technology. There are many IT companies which have significant exposure to BPO, and clearly AI chatbot are taking over BPO jobs. Even programming is not far off, and there are worries that AI related programming could take away many of the programming jobs. Undoubtedly, in IT, there will be two kinds of companies. One, which leverages AI to deliver better, cheaper, faster solution to customers. Now, if you are a large behemoth, to turn around a tanker is likely to be a bit difficult, but to turn around a speedboat might be easy. We have been bullish mid and small IT companies which are leveraging artificial intelligence, which has limited or no exposure to BPO. And we believe these companies should be able to gain market share as they provide better, cheaper, faster solutions to their customers. The companies which are investing in developing AI-related ecosystem, as many of the companies will develop their small learning modules, small language models, SLMs, they will also create an ecosystem which is closed loop. And this opportunity could be as big as IT services industry. So one will have to become bottom up in stock picking in IT services.
Right. Look at bottom-up stock picking in IT services. Mr. Shah, I wanted to understand about these narrative stocks, because given the fact that you've seen a lot of correction actually creep in, when I talk about narrative stocks, I'll be talking about the capex related theme, especially when you talk about the defense names, the power names. You've seen a sizable correction in those set of counters. Do you think that the correction that they've seen now merits a relook at these names? Do you think that they will continue to be a driving force going ahead?
So in a lighter vein, I will say, Asman se patke, khajur pe latke. These valuations have undoubtedly corrected, but they are still relatively high. For example, in defense, there is a great opportunity in exports market. But how many companies have technology that they can cater to exports market? How many companies have capacity that they can cater to exports market? How many companies have products which are futuristic in nature? As we have seen, the war scenario is changing. $100 million plane or a tank can be easily destroyed by a missile or a drone. So clearly in defense, companies which are catering to local as well as global market, which is futuristic in terms of their product profile, and which has capacity to deliver to local as well as global market should do well. Over there, some amount of narrative, some amount of valuation premium is justifiable. But all other defense stocks where valuations are still high, they don't have capacity, they don't have technology to cater to global markets. I think वहां पे आसमान से पटके खजूर पे लटके is still applicable.
Well, good analogy there. Explains it all, Nilesh. But, also the question then, Nilesh, is that when the market recovers, and I mean by recovery, I don't mean intermittent recovery, but a more broad-based one, along with, of course, earnings revival, what do you think is not going to come back? And where do you sense leadership will emerge? Will it continue to be restricted towards just banks? Or do you think it's going to get more broad-based?
So, Aisha, it's always difficult to predict where the next bull run will start. Normally, the players change, sectors change. And banks have been clearly underperformers. So there is a good chance that with valuation comfort, they could lead the charge. Consumer discretionary space also could lead the charge, as there are certain events like tax rebates and 8-pay commission to support them. Will this rally become broad-based? Well, it all depends upon FPI participation from a flow point of view or earnings momentum from the growth point of view. While we do believe our growth rates will start inching upwards, it's unlikely that we are going to move into 8% plus handle. We will still be 6.5% to 7% range. And with some divine intervention on oil and monsoon and global growth, it may go upwards of 7%, but unlikely it will reach 8%. So the broad-based rally, at least at this point of time, looks difficult unless until it is supported by growth or it is supported by flows led by FPIs buying.
And you don't expect FPI buying to kick in anytime soon, is it?
As of today, if we divide FPI categories, the long-only funds, the insurance, the pension, and the passive are on the selling side. The sovereign wealth fund and university endowment fund have been buying between October to December 24 quarter. So definitely all FPIs are not selling. In the long-only insurance pension, probably selling is driven by US-based FPIs who are taking money back to US on the promises of tax rate cuts, on the promises of tariffs and make America great again. On the passive side, it is quite emerging market. Emerging markets have underperformed relative to developed markets for last 5, 10, 15, 20 years. That has put doubt in the minds of global investors whether they should allocate to emerging market or not. Over a valuation point of view, emerging markets are much, much cheaper compared to developed markets. However, people need to see returns before they can try to catch a falling knife. I believe, at least in the near term, the FPI selling is likely to continue. Of course, they are all smart investors, so they are not going to sell at any prices. But at this point of time, keeping in mind the vacuum cleaner in America and quit emerging market movement, we do believe that FPIs are likely to be on sell side for some time.
Let's look at the other factors which are playing, Nilesh bhai. So India, okay, there's a graph which we put out yesterday that Europe is a rebound trade, China is a tactical trade, and India is a structural trade. Would you agree with it that if you are playing a rebound, which is like mean reversion, Europe le lo. If you're buying tactical, 6 mahina, China. Anything beyond that, buy India.
So, Nikunj bhai, one, it's not that people haven't put trade on India on a structural basis. We still have close to $750, $800 billion of FPI investment in listed companies. There could be another $1 trillion between private equity and FDI. So people have put money on structural growth story of India. Now we need to do better. Our GDP growth right now is in mid-single digit, 5, 6, 7. We aren't able to take tough decisions on reforms like land reforms, labor reforms, farm reforms, judicial reforms, ease of doing business. We have done a lot, but there is a long distance to cover. These are the reforms which can take India to 9, 10, 11% growth. That's unlikely to happen at this point of time. Now, clearly, if we want to attract money or capital on a structural basis, then our growth rate needs to go higher, not in the current range. People have already put in money, and they will continue to put money in India as long as we deliver on growth. The second is some divine intervention. When our peers score self-goals, undoubtedly it benefits us. Andhon mein kana raja bhi ho sakta hai. So we have seen Russia, South Africa, Brazil scoring self-goal. China was scoring self-goal, but they have rebounded very nicely. The amount of leadership they have taken on technology side, the kind of trade surplus they are running at almost $1 trillion is truly a miracle. And that is divided investors which are ignoring China's capital allocation inefficiency and its political game on Taiwan to go and invest in China. We either can pray for divine intervention where our peers score self-goals, or we can take reforms and continue building on the foundation which we have laid to accelerate our growth rate to high single digit.
All right, Nilesh bhai, appreciate your time. Thank you for joining us. And I like that green shirt. कोई तो Bulls के लिए cheer कर रहा है.
होली में लाल रंग बहुत खेल लिया, तो अब green रंग ही सही.
If you like this video, then like, share and subscribe to ET Now.